let me look at, imagine, I'm going to use the board out here. Imagine on 1/1/2016, I have an asset which is value is about 100 lakhs out there, and this 100 lakhs is of 10 machineries of 10, what is called as what I call 10 machineries out there at the value of 10 lakh each. That makes it 100 lakhs. Imagine there is a depreciation of 10% on this machinery every year. Now I am looking at a calendar here. I am looking at the value of this machinery as of 1/1/2018. Original value of the asset is 100 lakhs. Depreciation, imagine 10-year, 10% straight line depreciation. 2 years, 16 and 17, there is depreciation. That means there must be depreciation of about 20 lakhs out here. And the value of it is about 80 lakhs out there. Very clear? Now, on 1st of January 2018, I decide to sell 2 machines. And I decide to sell 2 machines, let us say at what is the value, I decide to sell 2 machines at about 8 lakhs each. Right? So that means 2 machines gone out here, in this particular case. So when I basically write my financial statement, I will say gross value 100, sale of 2 machines. What is the sale? 16 is the sale out there, what you have. Depreciation, what is the depreciation I will write there? 20, that is what you say. Now, what is the figure I get out here? 80 minus 16 is? 64. How many machines do I have? 8 machines. What is the value per machine? 8. So, is it 8 and 8, 64 out there in the process? Am I with you in this particular case? Out there? Yes. Now, in this particular case, what have I done out here? I have taken out depreciation. I have taken out what is called as the sale value of this particular machinery out there in this particular case. But when I take out the sale value in this particular case out here, what is the value I am taking out in this? In this particular case, I have to return the sale value. But what is the value that I should deduct from here? Should I deduct it as 16 or should I deduct 20? Because what is it? You have only the gross value out here. The gross value of each machine is 10 lakhs. So you have 10 machines out there. Now, when 2 machines goes out of the gross value, what is the gross value of the asset? Imagine this is not there for the time being. I don't take this. I take only this. Imagine I don't take this. Now, what is the gross value of the machine I hold? Is gross value of the machine what I hold 84 lakhs? No, gross value of the machine what I hold is only 80 lakhs. Gross value of the machine what I hold is not 84, it is only 80 lakhs. So what do? I am playing around with the gross value, not the net value. So what do? I sell 2 machines. When I sell 2 machines, what is the gross value of the 2 machines? 20 lakhs. I sell 20 lakhs out there. So now what is the gross value of the machines what I have? 80 lakhs is the gross value of the machine. Now I say, when I say depreciation, what is the depreciation value I have to deduct from here? Here you see depreciation is 20. What is the depreciation I have to deduct out here? 16 or 20? Sure, 16 or 20. Because you saw out here, depreciation was 20. Here, depreciation 20. So should I deduct depreciation of 20 or 16? Huh? No, you are not looking at 10% of weight. You are looking at what is called as what accumulated. Your accumulated depreciation is 20. So ideally you should deduct 20. Yes or no? How many of you say yes? Yes, no. What are we looking at in a balance sheet? What you own and basically only what you own. So what you own only 8 machines. So what do I have to charge? I have to charge depreciation for 8 machines. when I have to charge accumulated depreciation is 20. Out of that, 2 machines I have sold. It is not there with me. Why should I take the depreciation alone? I have already charged it in the P&L the year in which I incur the depreciation. So, the depreciation pertaining to the 2 machines, I am deducting that. So, net deduction 16. So, naturally the value what I own will be 64 out there. That is all what it is. Any questions? Any doubts at this stage? No doubts out here. So, basically, in this particular line, again I go back to the same thing out here. Go back to your accumulated depreciation. In that, look at balance as of 31st of March 2017. In that balance as of March 2017, you look at disposals and adjustments. The machine which you do not own, the depreciation which you have charged part of it, also I will take it out of the accumulated depreciation amount and throw it like what I basically did out here. That is all what is that disposal means. With you or not? Why Pratik? Why are you smiling? Something funny? No. No jokes, right? Nobody's cutting a joke with you. Anyway, fine. So basically, then you see what is called as the carrying amount out there in the process. What is the amount that is carried? Additions, disposals, etc. Basically, you look at that particular amount out there. Look at, they have given it for entire 2 years. We look at only 1 year. So basically, that disposals and adjustments are there. Then the carrying amount. Carrying amount is balance as of 2017. What are the additions? What are the final disposals? And what is the basic net amount out here is what you see in the last row. That is all basically what is carried. I go back to my non-current assets out here. We look at plant, property and equipment. Then we look at capital work in progress. That is also part of your schedule 4 only. Schedule 4, if you look at, that is part of your schedule 4 page number, I forget, 211. What is this capital work in progress? Where is it? Not 211? 210 itself. It is part of your 210. The first table, not the second table, the first table, last item in the first table in page number 210, capital work in progress. What is that capital work in progress? It is, for example, imagine you are constructing a building. On March 31st, you have constructed the walls and the foundation, there is no roof. Can you call it a building? It is not a building as of now. It is only a capital work which is in progress. But it's an asset that whatever shell what is there without the roof is owned by that particular company out there. So that is a capital work which is in progress. So the value of it. How do you determine the value of it? The amount of money you have spent till that date or till that stage is the value of it. And that is what you mention out here as capital work in progress out there. With you on this? Any questions? Move on further. Go to page number 196. There is what is called as intangible assets. The next one, that is schedule number 5. Schedule number 5 is page number 211. In this particular case, it's lump sum royalty, which you are basically receiving royalty, that is lump sum royalty and engineering support fee. Now, you are receiving some kind of a royalty. Why should I receive royalty? No, rather, I should pay royalty to Suzuki. Not necessary. You would receive royalty from your vendors also because you have given them technology to manufacture and supply to you. You might have given them technology to manufacture, so you would get some kind of a royalty in the process. There would be a vendor who would or there would be a spare part manufacturer who would be using your brand name, which you allowed him to use it because he is meeting the standards, he is doing that and selling, then naturally you get a royalty. You could get a royalty for using the brand from basically many of your service centers, showrooms, etc., whatever it is. There is what is called as a money that you have collected upfront. What is called as it's a capitalized amount which you have collected for using your brand out there. That is all part of your basically your intangible asset out there, or value of your royalty, brand, etc. out there. That is the entire value. That is what we basically talk about in that particular case. Next, I move to your schedule number If I look at page number 196, I move to your schedule number financial assets out there. In financial assets, I look at investments and loans, that is schedule 6, 7 and 9 and other financial assets. Schedule 6, 7 and 9. Schedule 6, 7 and 9, page number 212. You look at non-current investments. Don't look at the current part of it, we'll look at it a little later. Non-current. You are invested in what is called as, if you look at in this particular case, what are the associate companies, that is 6.1, 6.2 and so on and so forth out there. They will give you what is the associate companies they have invested in. Bharat Seeds, Jai Bharat Maruti, Machinoplastics, and then what is called as Capro Maruti, Hanon Climate, Krishna Maruti and so on and so forth. They have basically made their investment. That is all their vendors they would have holding their stock. If you look at, if any of you would have visited the Maruti plant in Gurgaon, it would be very interesting. They were the first to start that way because I have a plant, I have space for all my vendors in my, what is called as, in that entire factory ground out there. They all put up their shops. So what happens? I'm holding a stake in that. Why am I doing that? Because I'm ensuring there's going to be a constant supply and I'm look at jet manufacturing system, etc., etc., etc. out there. So basically, all these companies, you are holding a stake. When you invested in the form of equity. When you invested in the form of equity, it is an investment. When it is an investment, it's an asset for you. That is all what is there. Now, somebody can come up with, what is the value of that equity? Listed, unlisted, possible. Value, what is the value? Go back to the financial principle, accounting principle of being very, fine, beautiful, yeah, you guys remember, that's fantastic. So, I don't have to explain further. So, you know how to basically evaluate. Very happy that you guys remember. Look at 6.2 also, investment in joint ventures. 6.3, other equity investments. 6.4, investment in preference shares. And then you basically runs beyond that. If you look at 6.3, then after 6.3, basically investment in 6.5, you basically see that investment in 6.5 running to n number of pages out there. You can see the details, spend some time understanding the details of all that. Not part of this class, but you can spend some time understanding the details of all that. If you look at a Unilever's balance sheet, you pick up a Unilever balance sheet. This investment will run to at least about 8 pages. This kind of investment will run to at least about 8 pages if you look at a Unilever balance sheet. Now, why have they made their investment? Part of their treasury management. They have to park the funds out there. When you talk about treasury management out there, in this case particularly, what happens is in a treasury function, please understand, any company has to manage their cash. They cannot keep liquid cash. They have to park it somewhere. That is, I am getting money on my sales as of today. All your dealers pay advance and pick up the vehicle. Whereas you pay your vendors much later. There is cash, excess cash with you. So what do you do with the cash? You basically go and park that cash somewhere. You are playing around with that cash. Playing around means not you don't get into the market and play around, stock market, but there are what is called as a treasury management function. That is what is called as a treasury management function. The treasury management function will take that money, park it in XYZ places and ensure that the money comes back to you on the day in which you have to make basically the payment out there. So they park the money in all these places on as of 31st of March. On the 1st of April, it could be different, marginally. Because they have to withdraw some, they have to park some more money. It can basically happen in the process out there. The one places where they have parked the money in the process. Further, in this particular case out there, other financial assets, if I look at other financial assets out here, that is schedule number 9 and what is called a schedule number 12. We'll just focus on schedule number 9 and schedule number 12 out there. Schedule number 7 also, you see that. Schedule number 7, page number 218. Schedule number 7, page number 218. Non-current loans which are unsecured. I give loans to my employees. Long term, I give a house building loan to my employee. I don't know if the company policy is. At least government had it some time back, not after last 5-10 years. Now, I can give this kind of long-term loan, intercorporate deposits. These are all what is called as your long term. That is basically an asset what it is. Now, more details on it, you will not get out here. That is where you sign an NDA. If you are purchasing out that particular company, then you go and inspect their books of account and you get all the details and so on and so forth out there. Now, move from here to schedule number 9. Other financial assets, unsecured. Security deposits and others. Security deposits. You are keeping security deposits out here. Out there. You have to have a security deposit with the government also. You might have security deposits wherever you are operating also possible, and others out there. Then move to schedule number 12. That is where your unsecured part of it comes in. Other non-current assets, capital advances, prepaid expenses and leases, amount paid under protest or dispute. You are paid under protest. You are still disputed. You have, so basically there is an expenditure, somebody has claimed, you have a dispute. So what does he say? I will fight it, but first I have to pay, only then I fight it. But as of now, I have not treated it as an expenditure because I feel I am not eligible to pay. I might get back that money. I am treating it as an asset out there. If the verdict goes against me, on that year, whenever the verdict goes, I will take it off the balance sheet, write it in the expenditure. If the verdict is in my favor, then it moves from there to the current asset. That is, it becomes cash because I am going to get the money back out there. That's all. Any questions? Just watch out. From here, I move back to page number 196. I move on to what is called as the current assets out there. If I look at the current assets, then there is what is called as your schedule number 10. That is basically your inventory. That is where we start off with. Schedule number 10. Inventory is page number 220. Somebody asked me, work in process, how do you treat it? You actually see out here. I remember one of the class, I think one of you asked me in the class, work in process, etc. That is, in a manufacturing plant, half finished goods, a car without engine can be there, work in process. What is the value? How do you determine the value? Whatever amount of money that has gone into the manufacture of that particular component till that particular point of time. So this entire aspect out here, what you basically see. You see the raw material, work in process, finished goods, vehicle spares, total goods, loose tools, etc. Inventory includes transit inventory of raw material and stock in trade. You see, look at that statement below. Inventory includes transit inventory also, which is because it takes about 10 days for the truck to reach Chennai. The entire amount of things out there. That is what basically, if you look at this particular case. Move on to the next schedule. If I have to look at this next schedule out here, it says schedule 6 and 8. If you go look at schedule 6 and 8, 6 is basically pertaining to what is called as your investments. Your current investments will be there somewhere in the process out here. If you look at your investments out here, that is schedule 6, the top portion, the first schedule 6, you see current investment in debt mutual fund, aggregate value of the unquoted investment, aggregated value of the quoted investment, market value of the quoted investment, all is there. What do? You take the market value. What is the number? What is the figure you take? Market value is for you to indicate. Again, we follow the principle of being. That's all. Follow the principle of being very conservative. You don't take the market value unless until it is lower than the value of your investment. That is just an information which is given to you. Schedule 8. Next is basically, if you look at the schedule 8 out here, schedule 8 is more pertaining to trade receivables. Schedule 8, page number 218, pertaining to trade receivables. Here you see two classifications. Considered good, considered doubtful. Still doubt about it. And then if I say considered doubtful, then I make what is called as provision for the doubtful debt. That is, I say I have to receive 100 crores. But I may not receive 8 crores. I am doubtful about it. I create a provision. So, what is your asset? Your asset is not 100 crores. Your asset is only 92 crores. And 100 minus 8 crores. That is what they have done, basically, what you see. Am I with you on this? Now, some companies will say receivables which are more than 6 months due, which are less than 6 months due. They would classify receivables which are more than 12 months due, 6 months due, and then which are receivables which are less than 6 months due. Any kind of classification, you are allowed to do that. And please note, your auditor signs only in the first 3 pages. That is balance sheet, P&L and cash flow. That's all, not beyond that. Schedules are up to you, to the way in which you want to present it to your stakeholders. I don't use the word shareholders, I say stakeholders. With you on this? Now move on further. Last few minutes, don't worry. Look at your schedule 11, which gives you cash and bank balances 7, 9, and so on and so forth. If you look at your schedule 7, let us start with schedule 7, page number 218, schedule 7. Schedule 7 talks about your what is called as current loans related out there. That is, there is a current portion of the loans also. There is a small current portion, just one statement. Employee related loans and advances, which are current. That means immediately recoverable. 1 month advance somebody has taken. Now, move to schedule 9 out there. That is, it gives you some more details out here. If you look at your schedule 9, other financial assets. Interest accrued, secured, not secured, recoverable from related parties, others considered good, others considered doubtful, and so on. Because financial assets out there, some kind of an interest which you are eligible to receive on your investment and so on and so forth. Move further to your what is called as your cash and bank balances. Your cash and bank balances will give you the complete details of the money that is basically there with you in the process. The complete balances with bank, checks and drafts in hand. Please note, somebody said in the one of the classes, they said, I get a check, but it is not cashed. Right? I have not cashed it. It is neither in the bank nor in the form of cash, but it is in the form of a paper. So what is the value of it? That is also mentioned as on that day. I get a post-dated check, not considered. The check which is valid as on that day. The check which is valid on that day. I get a check which is dated April 15, not considered. That is not your money. Check which is dated March 30th, yes, that is your money, but you have not encashed it. Value. So it gives you an idea. So far, what we have looked at gives you an idea about the complete balance sheet, components of the balance sheet, and how to relate it with the schedules. It could have been a little flying over your head as of today, no problem. Try to look at it. Try to pick up another annual report of any company, your own company, you can look at it. And try to relate to the schedules so that you will, all these will not look like Greek and Latin to you. It will be more comfortable in flipping through the pages of an annual report. You should be, that is the finance part of it. Similar schedules are there for P&L also. I have not looked at the schedules of the P&L as of today. We will look at it in the next class. Next class, we will look at some part of the P&L. By then, I hope that you would look at an annual report. Preferably look at an annual report of a manufacturing concern. That is slightly better, more comfortable. Don't look at the annual report of a bank or a financial or a NBFC or a finance company, because you do not know, because when they say deposits are treated as liability and things, that you will get a little confused and barring my friend out here. So you don't look at the what is called as France company's balance sheet. Look at preferably a manufacturing company's annual. You can just download it from the web. Look through the schedules related. You will feel a little more comfortable, because when somebody is throwing the schedules at you, you are not going to get a little scared. You have to be a little more comfortable out there. Try to relate the schedules to what is there in the P&L also. I will spend some time in the next class and then we go on. Okay, thank you very much.